One of the most important things that we're going to be talking about during these presentations are going to be about the investment tax credit, or the ITC. One of the reasons why is it deals directly with the customer's finances and with their taxes. And if not explained correctly, it can mess up their taxes, cause audits, or just overall mess up their entire structure they had set up for their solar and their future payments. So we're going to talk about this in detail and make sure you guys understand what to say and what not to say about the ITC. So the ITC is a tax credit, and it's a dollar-for-dollar reduction in the income taxes that a person or company would otherwise pay the federal government. The ITC is based on the amount of investment in solar property. Both the residential and the commercial ITC are equally set to 26% of the basis that is invested in eligible solar property. The ITC then steps down according to the following schedule. Now, what you can and cannot say about the ITC is one of the most important things to take out of this entire module. So let's dive into this. What you cannot say is, I can review your taxes. Under no circumstances are you ever allowed to take a look at the customer's taxes and review them to tell them whether or not they qualify for the ITC. Even if you are a tax specialist or a licensed CPA elsewhere, you're not with us. So you have no authority to review that customer's taxes and tell them yes or no they qualify for the ITC. The ITC is based off of individual tax liability, which means you have to do some in-depth dives into it. Now, because you are also not licensed and certified to do so, you're actually breaking the law. There's a lot of very sensitive information on the customer's taxes, including their entire family's social security numbers and all their income. Do not, under any circumstances, offer to do it, and if they ask you to do it or give you permission, the answer is still no. You cannot, under any circumstances, review their taxes. Now, you can refer them to Form 5695. There's a qualification sheet on the back and how to fill it out. The other thing you cannot do is review their income, but you can refer them to a CPA for both these situations or a tax specialist. Again, you cannot review anything to tell them whether or not they qualify. You're there about solar, you're not there about their taxes or their personal income situations. So, reviewing these to tell them whether or not they qualify is not only against our rules, it's against the law. Do not get caught doing this. It is illegal. So the best way to not get caught doing something is just don't do it. We are not giving you guys permission. We are not giving you guys a back door to do it. Under no circumstances can you do this. I cannot be clear enough on it. And the reason why I'm harping on this so much is because there are a lot of organizations out there who actually teach some basic information on what to look for, and the customer ends up still being in a very bad situation when they file their taxes because, again, it is not your job. And the customer, they don't know any better. It doesn't register that that's not your profession, is reviewing taxes, and then they go actually file their taxes, it gets filed wrong, or they didn't qualify to begin with, so they have to talk to a CPA. Now, as far as the 5695, that form's important for a couple of reasons and can help the customer in a couple different ways. If their CPA or tax specialist doesn't know what the Form 5695 is, they do not know how the solar tax credit works, which means they may not be the ones that they want filling out their taxes and filing them this year for the ITC. Now, I know they love their mom and they've been doing their taxes for a long time, but they can come back next year. Okay, you guys can refer out somebody. So if you guys know a CPA or a tax specialist that's really good at their job and knows how to file for these things, or you talk to your managers probably have somebody that they can refer out to them as well. Definitely do that and help them out and just give them the information. Look, the Form 5695 is the federal form that's required in order to be able to get the investment tax credit. If your CPA doesn't know what it is, they just haven't been trained on how the tax credit actually works yet, and you could talk to somebody who does. Now, you cannot promise or guarantee a payback. Under any circumstance, you cannot promise or guarantee a payback to that customer. What you can do is explain how the situation works. It's based off of a person's individual tax liability. They have up to 6 years to claim the entire amount. Now, not 6 years to claim that full amount 6 times, up to 6 years to claim the entire amount. Because it's set on somebody's individual tax liability, that doesn't mean if they don't qualify the first year, they won't qualify down the road or over a period of time. So again, it's up to the CPA to structure it correctly and coach them on how to make sure that they're able to qualify for the entire amount. You cannot consult on what to do with the investment tax credit under any circumstance. You can tell them how it works and give examples of what happens if they don't reinvest it or if they do reinvest it, but under no circumstance can you consult on them what to do. You are not their financial planner. You can explain the amortization period. You can explain what happens if they don't reinvest, if they do reinvest, but it is not your job to tell them what to do, just how it works. You cannot call it a rebate or a deduction. It is not the same. It is an investment tax credit. It is a credit. It is not a rebate. It is not a deduction. It doesn't get filed on Schedule Cs. It has its own specific form. So make sure you take that separator between the two. It is not a deduction. It is not a rebate. It is a credit. And the sale date does not dictate the qualifying amount. The install date does. This is going to be important closer to the end of the year, especially when we're approaching step downs like this, and it's going to be insane next year in 2023 towards the end. We will be changing the proposals to reflect 22% ITC as of October 2022. The reason why, we have no idea when that thing will be installed because of permitting. Everybody's going to be flying to the permitting office trying to get as much solar installed on their house as possible so they can get the 26%. That's going to back up permitting. It is illegal to install a system without permits. So, the install date will dictate it, not the sale date. If it gets installed before December 31st, great. They got the entire 26%. If it's installed after the fact, they do not get the 26% tax credit. They'll get 22%. And in 2023, they'll get 0 if it's installed past December 31st, 2023. If it's not installed before December 31st, it doesn't qualify for that year's ITC. Here's examples of what the forms look like. You can go directly to irs.gov and search for the Form 5695, and it'll pop up just like that. Now, homeowners may ask whether or not they qualify for the tax credit. You can't tell them if they do, but you may offer information regarding qualifying systems, not their finances. There is no income cap to the ITC program, so that's important. Doesn't matter how much they make. Again, it's based off the individual's tax liability, not their income. So, your PV system must be installed between January 1st, 2006 and December 31st, 2033. What does that mean? It means that the ITC started in January 2006 and it ends December 31st, 2033. So, there will be some people out there who say that they never got the ITC. Find out when they were installed. Okay? Sometimes it could be that they were not told how to properly qualify for the ITC. Again, refer them to Form 5695 and a CPA or tax specialist. The solar PV system is new or being used for the first time. The credit can only be claimed on the original installation of the solar equipment. What does that mean? Well, if you buy a home that already has solar on it, you do not qualify for the ITC. The person who bought the system, who owned the home before, got the ITC. You cannot get 2 ITCs for the same system. What's important to know about adding on to an existing system is that if somebody bought a home that has solar already installed on it, but they needed more equipment, they can qualify for the amount of the new equipment installed on that home. You own the solar PV system, which means you've either purchased it with cash or through financing, but you're neither leasing it nor are in agreement to purchase the electricity generated by the system you don't own, or PPA. The company who's leasing the system or owns the equipment gets the tax credit, which means you have to be the owner of the system. You have to purchase it, you have to pay cash, check, credit card, or finance the system in order to be able to be eligible for the ITC. You do not own the system if you lease it. If you do purchase the system during the lease period, because there are options to purchase systems that you have leased afterwards, you do not qualify for the tax credit on that. And finally, the solar PV system is located at your primary residence or secondary residence in the United States, or for an off-site community solar project if the electricity generated is credited against and does not exceed your home's electricity consumption. The IRS has permitted a taxpayer to claim the Section 25D tax credit for purchase of a portion of a community solar project, which means if you use 8 kilowatts of solar and you purchased 8 kilowatts of solar for the entire community, you qualify to be able to get back 8 kilowatts worth of ITC. But Chris, I live in an area that requires new builds to have solar on it. Oh, okay. This is how that works. If a homeowner buys a newly built home with solar and owns the system outright, the homeowner is eligible for the ITC the year that they move into the house. If the homeowner leases a solar system or purchases the electricity system through a power purchase agreement or PPA, then the ITC is claimed by the company that leases the system or offers a PPA. So, if you buy a home that has solar on it and it's a new construction and you're the original owner of both the house and the solar, then yes, you do qualify for the ITC. Now, there are other types of credits and rebates that are available. Now, state tax credits for installing solar PV generally do not reduce the federal tax credits and vice versa. What's important to know, and I'm going to give you guys a full definition of it. It's not something that you're going to explain to the customer. I want you guys to understand that it can, but typically it does not. So if you come across this question on your certification that asks, do the state and federal tax credits affect each other? The answer is no. Typically they don't, but some states may vary. All right, so this is up to the CPA. Again, it's up to the CPA or the tax specialist, not up to you to explain this. So here's the information for your knowledge so that you can know that they have to speak to a CPA to figure out if it's going to affect it or not. Generally, the answer is no. So, when you receive a state tax credit, the taxable income that you report on your federal taxes will be higher than it otherwise would be because you now have less state income tax to deduct. The Tax Cuts and Jobs Act of 2017 placed a $10,000 limit on state and local tax deductions, which may impact whether the state tax credit impacts federal taxable income. The end result is claiming the state tax credit is that the amount of the state tax credit is effectively taxed at the federal level. So it could affect the tax liability. Generally, it doesn't. So, simple answer, hey, does the state tax credit mess with my federal? Typically, it doesn't, but I would check with your CPA to see if it impacts your tax liability. That's the answer. Always refer back to the CPA. You are not their CPA. The answer is no. You cannot tell them if they do. This is for you guys. It can get complicated depending on the state or on their personal situation and their tax liabilities. As far as rebates go, there are rebates. Under most circumstances, subsidies provided by a utility to install solar PV systems are excluded from income taxes through the exemption in federal law. When this is the case, the utility rebate for installing solar is subtracted from the system cost before you calculate the tax credit. For example, if your solar PV system was installed before December 31st, 2022 and the cost is $18,000, and your utility gave you a one-time rebate of $1,000 for installing the system, your tax credit would be calculated as follows. You take it out of the original price and then you figure out what the tax credit would be. Your proposals will automatically do this, and you'll actually see a check mark on the proposal that says whether or not there is a utility rebate that's available.